Good evening, ladies and gentlemen. Welcome to today's University of Chicago's Booth School of Business reception in the UAE. I'm Rajeev Kakar. I happen to be a career banker, but today I'm here in my capacity as a member of the Global Advisory Board of the University of Chicago's Booth School of Business, an association I've had for the last 10 years when I joined the Global Advisory Board, and it's an association that I'm deeply, deeply proud of. It's fascinating to have this event here today in the city of Dubai, because this is where the community of Chicago Booth students and the University of Chicago alum is growing. Several of them are here in the audience today, and I'm sure this population will keep growing, and that's what makes it very exciting. For those who are perhaps unfamiliar with the University of Chicago, it's one of the leading, well-known, research-based universities in the world. A university founded in 1890 by John Rockefeller, and it's perhaps well-known, or extremely well-known, for the number of Nobel Prize winners that it's had. I think the count I was told is 91. There have been 91 Nobel Prize winners, and there are several names that you would know, of which Professor Richard Thaler, Professor Milton Friedman, Professor Enrico Fermi, and of course the erstwhile President of the United States, Barack Obama, as well. And of course there have been several others. We had Richard Thaler in 2009 or 10 here. I remember I'd hosted his book launch, and he of course went on to win the Nobel Prize for Economics last year or the year before. Chicago Booth is the business school of the University of Chicago, and what makes it special is also its research-based approach. Chicago Booth started the executive program, the executive MBA program, in 1943, and I think we're in the midst of 2018 and 19, this making it the 75th anniversary of the executive MBA program. And in many ways we're very fortunate to have Professor Kroszner here, Randy, who has also assumed the responsibility within the college of being the Deputy Dean for the Executive MBA program, Executive Education Studies at the Chicago Booth University. What's particularly special about Chicago Booth, I guess, is the fact that it comes with a unique flavor of a fair bit of intellectual curiosity. It's got a flavor of its own when it comes to teaching. It's got a flavor of its own when it comes to the learning and teaching experience. It is known as a free enterprise school. It is a school that has influenced businesses around the world, governments around the world, through the work of its alumni who've been in the business world and the government, as well as the work of the professors like Randy here today, who have done a great amount of work to be able to help and steer and influence the economics and everything else that we face in our complex world today. I guess today you will get a live flavor of the intellectual capital that Booth offers when you hear Randy speak. More than that, you will also get a sense of the teaching approach, the learning experience. But one of the highlights of the Chicago Booth experience is that of rigorous debate. So I would encourage you all, while you sit in this masterclass, to use the session to engage with Randy at the end of his talk and perhaps ask questions and make it more interactive, because that will make it particularly special. Before I introduce the chief guest today, I would like to set the context a bit. 2008 and 2009, I remember being extremely worried, and I'm sure everyone in this room and perhaps everyone in the world was worried, because we were in the midst of one of the worst crisis that the world had ever experienced. As a banker, I've always seen crises happen. If you go back every 3, 4, 5 years, you will face some kind of crisis or the other. But this crisis was something that we hadn't perhaps seen in our living life, with the previous crisis having come in the Great Depression of 1929. Obviously, that led to governments being under difficult conditions, companies crumbling, people losing jobs, and you know, I spent a large part of my career in Citibank, even my former institution, getting heavily impacted. So what did governments do? What did business leaders do? What did thought leaders do? What did economists do? They obviously came out with a set of responses in the hope that the situation and the solutions that they would offer at that time would end up creating a better world, a better and a safer world, and a far more stable world for the rest of us. Fast forward, we move 10 years hence. We today see a world that has gone through intervening crises, whether it was the Arab Spring, whether it was the European debt crisis, whether we've seen conflict and turmoil, or we've also seen a whole lot of stuff happening around the introduction of robotics, obsolescence of jobs, mismatch of skills, and fake news. Everyone today is an economist, everyone's a journalist. There's more news read today on WhatsApp links than perhaps is read by people who've actually gone ahead and written about it. So where is the governance behind journalism? Where is the governance behind the written word? Where is the classic truth element of what we should believe and what we shouldn't? In today's world, it's not about what you read, it's about what you know not to read, because you need to be able to make sure that you form the right view. And that, in some ways, impacts us all. We're sitting in a world where 8 weeks from now, we're not sure of which way Brexit goes. We're not sure whether we will have a deal or we won't have a deal. We're sitting in a world till the end of December. We were facing a lot of guidance from the US Fed that we were going to go through a gradual tightening process. And comes January 2019, and suddenly we see a complete reversal. We no longer have a guidance. We no longer talk about, we dropped the word on the gradual rise. The US Fed chairman dropped the word on the gradual rise of rates, and he's talked about data-driven decision making. What does that mean? It just means a lot of confusion, very hard for people like us to know what we can do. And there's a reference there to the fact that even balance sheet shrinkage decisions could be changed. In the midst of all this, we live 10 years out in a world that's heavily in debt. Institutions, governments, we are over-leveraged in debt, and individuals. There is a complete mismatch of supply and demand. There's been so much stimulus that the world has offered to everyone that a lot of capacity has been built up, but the demand is not keeping pace with it. Disparity levels have widened. And then, of course, we have governments who are misaligned in their actions, central banks who are completely misaligned in their actions. And for the first time, we are seeing the rise of populism and nationalism and protectionism in this world, which completely goes against what we had learned over the years. For decades, we believed globalization was the right answer for us. And now, if I may say so, and I'm certainly not equipped as much as Randy is, but I'm trying to provoke Randy and hope that he can respond to some of these things. We are, I feel, moving through a process of active deglobalization. And I think every few decades, these changes happen. And with the emergence of deglobalization, what we often see is the emergence of very strong leaders. So Trumpism, or some of the other leaders in the other parts of the world, the kind of actions we are seeing in Venezuela as we speak, the kind of actions we are seeing in much of Europe, the Italian crisis, the Greek crisis, the responses to those, and the emergence of Russia, some of the issues which are happening in the region, and of course a very aggressive China, elections in India. So we are seeing the emergence of leaders who are far more protectionist. Nationalism is becoming stronger. The world is no longer the preserve of an open, fine, sharing world. And we've been talking about a sharing economy for 20 years. We've been talking about things opening up, but suddenly we notice that the disparity levels, the differences that have been created have led to a lot more of protectionism. Jobs are going. So clearly people are worried. What responses are governments and economists going to have to be able to make sure we live in a world where information can be trusted, money can be made, where people can hope to have jobs and people can hope to make sure that they have a meal to eat and can recreate their skills and be able to educate the kids and they live in safety. All that in this world of volatility, uncertainty, change and ambiguity, the famous VUCA expression, makes it very hard for us to fathom as mere mortals. And I guess we're lucky to have Randy here today because he was one of the people instrumental in responding and drafting some of the responses to the 2008 and 2009 crisis in the US. But clearly, when you're dealing with a superpower like the US, these things impact the rest of the world. A 0.25% interest rate hike, or a 0.25% interest rate freeze, or an active or passive shrinkage of or expansion of a balance sheet will make a lot of difference to this part of the world and to much of the emerging world. Well, at that point, with a lot of hope and a lot of fear signals, I'm going to very quickly introduce you to the guest of honor tonight. It is my great privilege to introduce you to Professor Randall Kroszner. Professor Kroszner is the Deputy Dean for Executive Programs at Chicago Booth. I normally don't like to read, but I have to read this bit because there's so much that defines all the great work that Randy has done. So if you will forgive me, I'm going to read his introduction so that I don't miss out on any of it. Professor Kroszner is the Deputy Dean for Executive Programs at Chicago Booth and the Norman R. Bobbins Professor of Economics. He served as the Governor of the Federal Reserve System from 2006 until 2009. During the time at the Fed, he chaired the Committee on Supervision and Regulation of Banking Institutions and the Committee on Consumer and Community Affairs. He therefore played a leading role in developing responses to the financial crisis, as I mentioned, and in undertaking new initiatives to improve consumer protection and disclosure, very needed in the world today, including rules related to home mortgages and credit cards. Prior to joining the Federal Reserve, Professor Kroszner was a member of the President's Council of Economic Affairs. He was involved in formulating policy on a wide range of issues, including responses to corporate governance scandals. There are lots of them nowadays. He appeared this morning, by the way, on Bloomberg TV in Dubai, so you will get to see that. He just interviewed with another platform called Mad Talks, and he's also a frequent flyer providing advice to financial institutions, government organizations, and central banks throughout the world. And with those words, and I hope I've done justice to you, Randy, please join me in welcoming Professor Randy Kroszner, and I hope you enjoy the evening.
Thank you so much.
Thank you.
Well, I'm absolutely delighted to be here with you. Thank you for that extraordinarily generous introduction. Rajeev is an extremely important person to the University of Chicago, and particularly the Booth School of Business. He's someone who really believes in the importance of education and of lifelong learning, and has been a great advocate for the university and for the business school. And we really thank him very much, because one of my goals as Deputy Dean is to make sure that the ideas of University of Chicago and Chicago Booth are ideas that influence business practice and policy throughout the world. And that's one of the reasons why I'm delighted to be back here in Dubai. I actually first came to Dubai when I was at the Federal Reserve in 2007, and I believe I was the first sitting governor of the Fed to come to UAE, because we were very interested in making sure we had the U.S. government continuing to have good relations with the Gulf region, and to exchange ideas, exchange views, and make sure that people understood that we really wanted to be engaged. And so I'm delighted to be back here now a decade later in this role as Deputy Dean, and give you a little flavor of what it's like to be in a University of Chicago class. So I'm really delighted and particularly pleased that so many people are willing to come here to a class in the evening and sit through, hopefully it won't be a full hour of lecture. Hopefully it'll be interactive, exactly as Rajeev said. So I'm going to be posing a question to you a few minutes into the talk. So please be sure to be ready to answer. Don't be shy. I know it's a big audience. And that's what we're about. It's a very interactive kind of thing. It'll be a little bit less interactive today because of the way we're set up. Usually the classes are a bit smaller, and that's one of the things that's wonderful about Booth, is you not only learn from the professor, but you learn from others in your class who you are talking to and hearing from. And I think there are three key things that really differentiate the Chicago approach, particularly executive approach with the executive MBA, and for our shorter programs, if you don't have time to be able to come to take the full MBA, either in Chicago or in the executive program, which is in Chicago, London, and Hong Kong. I think there are three things that really differentiate us from the others. And the first is this kind of Chicago way of thinking, which is a discipline-based approach. So what we do is try to always go back to the fundamentals, the fundamental frameworks for decision making. And why is that so important? Well, exactly as Rajeev said, during the financial crisis, there were a lot of people who really felt they didn't know what to do, because my goodness, something like this hadn't happened since the Great Depression. How do we think about that? Well, if you have a discipline like economics and a discipline like finance, you know that even in a crisis, certain things will operate in certain ways. And you also, it gives you the confidence to try to make decisions about, well, what data do I need to be able to make a sensible decision or not? How am I going to try to respond to this thing that hasn't happened in a very long time? Well, I need some way of filtering through the data. I need some way of figuring out how to respond quickly. What are the priorities? And that was something that was very helpful for us at the Fed during this time. Both Ben Bernanke and myself have done a lot of work on the 1930s, and so knowing that particular example was valuable. But having frameworks for thinking about how economics can be useful for trying to manage a crisis was extremely valuable. And that's what University of Chicago teaches you, that discipline-based approach that gives you these frameworks so that you can make decisions in areas that you don't have familiarity with. For example, particularly for our executive MBA students, and many people come to our executive programs, they've become area experts. They're superb at being a controller, at being a CFO, at being a marketing person. But if you really want to go into leadership, you've got to go to the next stage. And what that means is you're making decisions in areas that you don't have that depth of functional knowledge. That's the only way that you can be a leader, is to do the big picture things, not to do the individual things anymore. But how do you do that? Because you don't have that same level of familiarity. Well, if you have a series of frameworks that'll allow you to make those decisions, it'll allow you to get the confidence to make decisions in areas that you don't have the functional expertise in, but you know what questions to ask. You know when people bring you data, how to filter through that data, and that's going to be one of the questions I'm going to pose to you, and that's one of the things that comes up in class. So I think that's something that kind of fundamentally differentiates the Chicago approach from other approaches. For Executive MBA program, it's truly a global program. Unlike other programs where usually there are local partnerships that are done, we don't partner with others. We have a campus in Chicago, we've got a campus in London, we've got a campus, a beautiful new one that just opened up in Hong Kong. It's all our faculty who go there, and it's one program. Everyone comes together in Chicago for the opening. People then go back to their individual campuses, but everyone will go to Hong Kong at one point, and everyone will go to London at one point. Also, the program is set up, since it is a truly global and integrated program, that if you are from your corporation move to Asia from Europe, you can continue the program in Hong Kong. And vice versa, you can continue in London or come to Chicago. And as I said, we bring the students together at the beginning, but also at the end of the first year to do elective classes. And that's what I'm going to be talking about here. This master class is going to be a very condensed version of the class that I teach on money banking and the financial crisis in the electives in the summertime. And it's exciting for me because it brings together people from around the world. And the financial crisis was experienced differently around the world. It started in the US, but there were global consequences of it. And then you had the Euro crisis in Europe. Asia had experienced crises earlier and experienced the crisis in a different way. So to get people from around the globe in the classroom talking about these things is very exciting and fun for me, and I think really enriching for the students. So that's the second thing that I think really differentiates us, a truly global program that's all University of Chicago based. And the final piece is that that community and collaboration that you get from bringing people together from around the world. We have, as I mentioned, the summer electives that what people come together for, but we also have something called the Global New Venture Challenge, where people form groups of roughly 5 or 6 students, and they pitch ideas for new ventures, because so many people want to be involved in new ventures. That's also true for people at existing companies. They really want to have that entrepreneurial way of thinking. And so people come up with business plans. They present those business plans to a panel of entrepreneurs. So it's a little bit like that television program Shark Tank, but it's not quite as snarky as Shark Tank. It's a little bit more substantive. But like Shark Tank, there's real money at the end. So each of our campuses has a competition. The top 2 from each of the campuses then come together at the end. They compete, and the winners get real funding from money that we have, our generous donors have given to us, and also sometimes from the judges, who, much like on Shark Tank, will say, hey, you may not have won, or so-and-so may not have supported you, but I want to support you. So it's a really great way to build community. It's a great way to be engaged, how people get to know each other, how they get to know our alums, and it's something that's real practical business experience. It's taking those frameworks and putting them in practice of how you would actually structure a company. And we've had a number of enormous successes from this. For example, one of our graduates founded Braintree, which he sold to PayPal for literally hundreds of millions of dollars soon after he had graduated from the program. So we've had a number of big successes, and so I think those things are really fun things that makes Booth different and exciting. So spread the word, because I think there's a lot of exciting stuff that we can do, and for you and for your for people in your organizations, and for people that you think really want to go to the next level. So what I want to do now is turn to talk, give you a condensed version, a little mini version of some of the ideas about lessons from the global financial crisis for this so-called masterclass tonight. And what this is not what I'm going to go through tonight. It'd be much too much to try to go through. This is the class. But what I'm going to do is take highlights from the first 2 pieces of the class, because what we're going to do is, as I said, there's always got to be a framework that we're thinking about. So I don't want to just get into the details of the financial crisis. I want to think about, well, why do we care about finance? Why don't we just sort of stop all this stuff? Because we know it can cause a lot of trouble. Well, let's think about the costs and benefits. Think about those trade-offs. When can finance help to promote growth, and when may it have the downside of some volatility? So you want to get that big picture growth and volatility framework in first for thinking about what the financial sector does, and that helps you to think about how it can do it well and how it might not do it so well. Then what I want to do is talk about the sources of financial fragility, which are key things that I learned when I was at the Fed during the financial crisis. As Rajeev had mentioned, I was chairing the Supervision and Regulation Committee during my time at the Fed, and I was there from 2006 to 2009. It's not all my fault. Everyone always wants to blame the Fed and supervision and regulation. Certainly there's a lot of blame to go around. I wouldn't want to say that the Fed was by any means blameless, but we can talk about that, and hopefully during some of the questions you'll be able to bring that up. But I learned an enormous amount about how markets actually operate in practice, and one of the things that I try to do is distill out, well, what are the essence of, if you're looking for fragilities? And so whether you're on the policymaking side, or if you're operating your own firm, or doing your own investments, or working in a company, what are the risks that are out there? What are the key things that you look at to try to see, are we in a risky environment or not? How should I, what are the sorts of things that I should be prepared for? And I think you can kind of distill it down to 3 particular things: leverage, liquidity, and interconnections. In the class, I'll go through a particular case of Northern Rock, which is actually very interesting because it's the first bank run that the United Kingdom had in more than a century, and it was the first bank run that occurred in the financial crisis. But it was a little bank in northern UK that had no exposure to the United States and no subprime lending, And this was supposedly a subprime lending crisis. But that's the interesting thing about interconnections, and that's a nice way to illustrate some of the points that I'll be making more generally tonight about interconnections. We'll be thinking about some global spillovers, some of the issues that Rajeev was asking me about, and hopefully in the Q&A section maybe I can touch on some of those, some regulatory reforms, and then thinking about crises and mini cases in which I get the students to talk about their experiences, because the classroom is a classroom full of case studies, and to draw out from the students what their experiences were, what they learned, what they are doing differently is extremely valuable. It's a great way for people to learn from each other. So what we want to do is we always want to think, well, what's the primary goal? What's the primary objective when we're getting out our basic framework? And so we have to think about, well, what's the goal of the financial system and financial regulation? And it should be to support and enhance sustainable economic growth consistent with reasonable consumer protections. Now, I've underscored that word sustainable. In Washington, we call that a weasel word, because it's, what do you exactly mean by sustainable? Because it's not that well defined. But so it's it's not saying it's the maximum amount of economic growth, because you can drive a lot of credit into the system, have short-run economic growth go up really dramatically, but then come crashing down. So what you want to try to do is set up for a sustainable structure, which means making sure that you've got you're not creating imbalances through the financial system. And why do we care so much about the financial system? Why are we focusing on this rather than telecommunications or public utilities, electricity generation? Because of course those are incredibly important for the system. If the lights went out, we couldn't be having this lecture. If the telecommunications system went out, it'd be very hard to do business. You wouldn't be able to send emails and such. But if you have problems in those areas, that doesn't tend to turn into a broader crisis for the economy. When there's a problem in the financial system, it does turn into a broader crisis for the economy, and that's why we care so much about the financial system, as well as also about the potential good that the financial system can do in potentially generating economic growth. So there's a long history of debate about this, and it really goes back roughly a century ago to this guy Joseph Schumpeter, who argued that the financial system is a driving force behind economic growth and development. And so here's a picture of Schumpeter, and we're going to ask briefly, is Schumpeter right? I'm going to try to give you some data associated with that, and I want you to think about whether the data that I'm going to give you completely answers that question or not, or whether it's a driving force. Now, Schumpeter looms large in my life personally, because where I went to graduate school, you had to pass your exams in order to write your thesis, but you also had to pass an oral exam. And so there was a small room in which the student is sitting down low, the faculty members, there's a panel of 3 looking down onto you, shooting questions at you. And in this room, there were photographs of some of the famous economists who had been in the economics department in the past. And Schumpeter's portrait was right staring down at me, so you get that very stern German look coming down at me. And so one of my questioners was Larry Summers, who is, can be, he's a good friend, but he can be very tough. As you know, he's sometimes gotten into a little bit of hot water because he hasn't always been, people haven't always gotten along with him as well as they could. And so he had this great technique where he'd ask you a question, but he starts off with an easy question. And then as you're answering it, he interrupts you and goes, no, I got it, you got it. So let's go on to the next one. So he'd ask the next question a little bit harder. He'd let you go a little bit longer, but then interrupt you as you're getting right. Yeah, you got it, I got it. Then he asks you another question that's more difficult. You start talking, and then he doesn't interrupt you. And so then you're thinking, oh my goodness, am I just hanging myself here, making a fool of myself? Because he hasn't interrupted me. So it's a really good way to make sure that the person knows what they're talking about, but it can also make people feel a little uncomfortable. And but Larry's, as I said, a great friend, and so I survived that. But under those kind of pressure situations, I sometimes let my mind wander a little bit. That kind of eases some of the pressure. And I thought about and in that situation, I thought about a story that's associated with Schumpeter. And he had said that at the end of his life, he said there were three things that he had wanted to try to achieve. He wanted to be the greatest economist in the world, he wanted to be the greatest horseman of the world, and he wanted to be the greatest lover in the world. And he said that he achieved two of those three. So I'll let you take a look and figure out which two of those three, but never judge a book by its cover. So don't, I won't be able to give you the answer to that one, but as I said, don't judge a book by its cover. Also, I'm a big movie fan, and then if you take my class, you'll hear a little bit about movies. There's a movie from the early part of the 20th century, a German movie that I'm sure that Schumpeter would have seen, called Nosferatu. And so Nosferatu is sort of Dracula, and he was certainly a ladies' man at the time. So you can see there's a little bit of, are they separated at birth, a little bit of similarity that's there. But now let's get to the data. But Schumpeter really posed this question, so is finance a driving force behind economic growth? And so what we want to do is try to see, is there evidence for this? And so what you have to do is you have to come up with some sort of estimate of, and some sort of measure of the financial system and financial sector development. There's no simple way to do that. There's no right answer to do that. And so this one study that I'm taking a look at takes a few different ways to approach that. I'm only going to focus on one of the measures, but when you're not sure, you take a few different approaches, and it turns out that they all give you the same kind of answer, but it makes sense to take a few different types of approaches. I'm going to be focusing on this one particular piece here called Privy. That is one that has been used subsequently in the literature. There's a lot of data, so we can look at a lot of countries with that information on it. And as you may see, I'm using a somewhat older study. It only goes through 1989 there. And the reason for using that is that in academia, you can't just republish something that someone has done before. You have to add a lot of bells and whistles. It becomes incredibly complicated. You kind of lose the point. Unfortunately, that's the way publications work. And so I use this earlier study, which really had kind of the brilliant insights in it, and then I'm going to show you some data from a more recent study to show that the same ideas persist today. But I want to try to get the basic the idea out. And so what's done here is we look at this measure of financial sector development, which is looking at basically the amount of financing that's given to the commercial and industrial sector. More formally, it's the amount of finance outstanding to the non-financial sector, because you don't want to count the financial sector in, because you'd be double counting, because the banks are making loans to companies that are doing things. You don't want that double counting. So it's the amount of finance that is being provided to the non-financial sector relative to GDP. Is that the only way to define financial sector development, the size and importance of it? No, but it's a perfectly reasonable way. And there's some other ways here. I won't go into the details here this evening, but there are different ways of approaching, more focusing on banks, more focusing on other aspects of the financial sector. And then what you do is you take these 80 countries, look at this long-term growth rate, and so you're looking at growth of GDP per capita, so per person, and say, well, let's break them up into four different categories. The ones that grew the fastest, and so that's this group here where GDP per capita grew at more than 4%. The next set of 20 that grew at about 2.5%. The next set that grew at about 1.5%. And then unfortunately the lowest 20 over this long time horizon, this 30-year time horizon, that actually really didn't grow at all. And so if finance is a driving force behind economic growth, what you'll find is that the more developed financial sector should be biggest and the fastest growing, not quite as big in the fast growing, a little bit smaller in the slowest growing, and smallest in the very slow growing. That's exactly what we find. And so there's a very high correlation with growth that is statistically significant. So that's certainly very much consistent with a view that finance is a driver of economic growth. Well, then you want to step back and say, okay, that's fine. That's a nice finding. But what's the mechanism? How could this be? What is it? Because other people argue that, well, it's not that finance is driving growth, but that, well, I'll come to that in just a second. want to see, well, what could be a reasonable mechanism of what's driving growth. And so what we can think of is, well, what growth is, why the development of the financial system can drive growth is really about allocating capital efficiently. And so it's gathering capital together and then allocating it out to the best projects. So think about a country, for example, like India. So my good friend and co-author and also former central banker, Raghu Rajan, had been at the Central Bank of India, and he really wanted to try to develop the banking system in India for two reasons. One, it was going to be very beneficial to a lot of lower income people in India, to, rather than just hold on to the rupees, to bring them together to financial institutions where they can get a higher rate of return. And also, if that savings is brought together in those institutions, it'll then be allocated out to, or hopefully be allocated out to the best projects available. And so you can have a much more efficient gathering as well as allocation of capital. If you don't have that, basically, if you have a good idea, you have to have a wealthy aunt or uncle to make sure that they can finance it. And we know that there's no correlation between having a good idea and having a wealthy aunt or uncle who can finance these things. And so it's a much less efficient way of allocating things. And so that could be the mechanism, or one of the mechanisms, by which finance can be a driver of growth, more efficient collection and allocation of capital. And so what this is here is looking at that same measure of the non-financial sector, credit to the non-financial sector relative to GDP, and break it down into the countries that had the fastest growth of the capital stock, that is the amount of the stock of investment that's there, the ones that grow second fastest, third fastest, and slowest, and you find exactly the same result as we found before, that this measure of financial sector development is higher for those that have the highest growth rate of the capital stock, second highest for the next highest, third for the slow, and lowest for the very slow. And so that's consistent with Schumpeter's view that finance is a driver of growth, and also that and that this is a particular mechanism by which that occurs. So now here's the question. So I've argued that these data are consistent with Schumpeter's view that, that finance is a driver of economic growth. But what other data would you want, or what's missing from here, in particular what's missing in how I've described this, to really answer that question, that it's a driver of growth? So I've presented you with some data that's certainly consistent with that view, but does it really answer the question that finance is a driver of growth? What else would you want to know, or what's not here that you would want to have? Yes?
If I recall back in 2007 and recently, we have the problem that sometimes credit has to increase tremendously for an increasingly smaller increase in growth.
Mm-hmm.
So what I would like to know is perhaps the level, absolute level of credit that this correlation works at. So if credit is already at a very high level, maybe the correlation breaks down. And if you increase credit even by a significant amount, you get less and less of an impact.
Excellent. So that's one of the points, because what this is saying that there's a simple linear relationship. More finance, more growth. But what you're saying is that at some point there could be too much of a good thing. There might be, and you might get negative impacts, or at least very much diminished impacts of economic of financial sector development. Good. So that's one piece. I'm going to come back to that with more recent data to get at exactly that issue. What else? Yes, sir.
What could be the other variables which relates to this growth? That's question number one.
Yes.
Second is, could it be the reverse, that countries which are growing very fast, finance is also growing. So how do you account for which is the cause and which is the effect?
Excellent. Wow, everyone's going to get an A in this class. I'm really, really impressed. Those are getting at exactly the right issues. And so, first, I haven't controlled for other variables here. There could be things about the quality of the legal system. It could be things about the quality of financial regulation. There could be a whole variety of other factors that come in. And so subsequent work has done that. They tried to control for all that by putting various measures, a whole variety of measures of institutions, other aspects of the of economic development that are in there, and these kinds of results still come in. The key question, the second part of what you said is, this is a correlation. This is not causation. What we've presented here is just data that's certainly consistent with that view, but he said it's a driver of growth. Well, what if it goes the other way? And that was exactly the argument in the early part of the 20th century. Well, what it is you get these big companies that develop rapidly, and then the banking system's brought along behind them. So rather than being a driver of growth, it's really the caboose on the train rather than the engine of the train. And this doesn't differentiate those two hypotheses because it's just a correlation. And so what these guys do in this is they try one. This is a simple way to get at it. There are much more sophisticated techniques that have been done subsequently. But what they say is, okay, we've got data from 1960, 70, and 1980. And all the years in between. But what we'll look at is the initial level of economic growth, the initial level of financial sector development in 1960, and then see, well, how does that play out through the 1960s? So try to get what comes first, the financial sector development, then leading to growth. Then look again in 1970 and say, okay, let's look at financial sector development in 1970 and see how that relates to growth in the 1970s. Let's look at financial sector development in 1980 and look at the growth through the 1980s. So that's a way of trying to address the issue. Is it perfect? For sure not. There are much more sophisticated techniques, and I'm not going to go into all the econometrics of that. But what you find here, both for the growth of GDP per capita up on the top and the growth of the capital stock, that when we look over these initial decadal values of this measure of financial sector development, it does seem to lead to subsequently higher economic growth. It does seem to lead to subsequently higher investment growth. And so I think that's very important to get at these kinds of issues, and as very important as part of the Booth training to say, people often make certain assertions, or like people in your organizations may really want to do some sort of project. They're going to present you with data on, like, this is really why we should do this project. And you've got to be able to think critically and ask critical questions about that. Just like here, the distinction between causation and correlation. Certainly all this was completely consistent with it. That was certainly right, but it didn't really nail it because it was correlation rather than causation. You want to control for other variables, exactly as was said. And in addition, what you want to do, I'll just skip over that, is to see, getting back to exactly the point that this gentleman made over here, is there can be too much of a good thing. So this is now rolling forward. This is a more recent IMF study that is using the same kind of data. As you can see, the credit to the private sector relative to GDP is along the axis in the bottom. So that's looking at the development, exactly as this gentleman was saying. Maybe the relationship is different when you don't have very much financial sector development, as opposed to when you do have a lot of development. And that's exactly what this is getting at. So this is the result of a regression that takes into account a lot of different factors. Try to say, well, what, after you try to control for all these factors, what's the impact of credit to the private sector relative to GDP on economic growth? And the solid line has that, the standard error is the dotted line. So basically, how confident are you that you're really getting a positive impact? And you can see when the financial sector is not very well developed, so that would be more emerging market economies, there certainly seems to be that positive relationship that shows through even in the more recent data, even with more sophisticated techniques. But it seems that somewhere around between 3/4 and 1, that relationship starts to turn down, exactly as this gentleman had said here. Perhaps there's too much of a good thing. perhaps the fragilities become important, and maybe some of the efforts of the financial system, rather than really being directed at allocating capital more efficiently, are being used in other ways that are not nearly as effective, and maybe cause some of the fragilities that we saw in the crisis. And so the positive thing is that even out here at 1.5, so 1.5 or 1.4 of credit to the private sector relative to GDP, that solid line is still in positive territory. But you can see the dotted lines, which are where you're reasonably confident that that's where the estimate is, they become pretty wide. And so, someone who's very optimistic, so let's say someone like Jamie Dimon, the CEO of JP Morgan Chase, would be at the top edge there and would say, this is why we need to have light touch regulation, this is why we need to let the banking system really develop. Down on the bottom there, one of the senators in the US who's been extremely critical of the banking system is Senator Elizabeth Warren, and what she would say is the data clearly show that this is a disaster. This on net reduces growth, and so we need to push back the size of the financial sector. And so what you can see here is reasonable people could disagree. Now, some people would say neither of those individuals are reasonable, or both of those individuals are reasonable, however you want to take it. But you can have reasonable people disagree because the statistics don't tell you enough information about as finance gets really wide, whether it goes negative. But it does seem to have a bit of a downturn, exactly as the gentleman said, that the payoffs tend to get lower. For emerging market countries, so getting up to about 3/4, clearly positive. After that, much more of a question. And so it has this nonlinearity in it, because we were assuming before that it was just a simple linear relationship, bigger is better. And here it's questioning that at some point. Maybe it turns down. And you can see a lot of policy debates are really around exactly this issue. When does it turn down? When could we have too much of a good thing? And so that's obviously something that continues to be debated around the globe. Any questions on this before I move on to think about the fundamental fragilities? Yes, sir.
This is a comment. I like the ratio of growth on credit on the growth of GDP. If surpasses, that is a danger zone.
I didn't understand the last part.
Okay. GDP growth.
Yes. Oh, here, so everyone can hear you.
GDP growth on credit growth. So if credit growth surpass GDP, and that's the danger zone. Maybe by 2%.
And so this would suggest that once credit to the private sector relative to GDP gets around 1-to-1, then you could have this downturn, that it could start to have a negative impact on growth. And so what this is saying is when it's at its best, it's adding, as you said, roughly around 2% to GDP growth, but then it turns down at some point. This is trying to control for all of the other factors in the economy, and so the regulation of the system, the legal system, et cetera. And so this is just the impact after controlling for those other factors, but those other factors are also very important. I wouldn't want to say this is the only factor, but it is the one important factor, or it is one important factor. Any other questions on that? Yes, sir.
So in this study, was there any breakdown of where the credit was going? So we were saying credit to private sector, so was it going to the productive sector, or was it just retail lending, which is not necessarily paid for GDP?
So some of those other variables look more at things like just bank lending, for example. And then others have looked at the role of the stock market and other aspects of finance. And so generally you get this kind of pattern even when you break things down into the different pieces. Yes.
Just a real quick
sure.
time frame for this.
Yes, so this is from a 2012 IMF study, so it goes just through the financial crisis and goes back to the 1960s as that other data. So basically it updates that other data set, But of course, everything has to be new bells and whistles, so looking at this so-called nonlinear relationship rather than that simple linear relationship from before. So it's looking at, so from roughly 1960 to 2010. So 50 years worth of data on more than 80 countries. Yes?
So does this have to do with the marginal utility of money? Is that what's happening here? You're getting diminishing returns.
You certainly are getting diminishing returns, and so it's the same theoretical framework, but the application is not specifically to money. It's here to sort of credit relative to GDP. You're getting diminishing returns and maybe even negative returns as you're getting out there. So conceptually it's similar, but it's somewhat distinct from just money as itself, and it's in particular credit going to the private sector. Yes, I think you had your hand up. Yes.
Has there been plotting of a lot of these things are impacts? I'm looking more at what are the cause of it. Has there been plotting to say, is there a correlation between all this and, let's say, consumer confidence a year before this, 2 years before this? So you actually look ahead and you say, this is all very good, we're growing great, but confidence seems to be peaking out, and therefore I expect this to peak out later. Has there been any study on that?
So some of these studies have tried to take into account a variety of factors, so some like that. And so these kinds of studies tend to be very long run. So looking at 50 years worth of data. And consumer confidence sort of moves up and down more in the short run. But you're getting, the question that you're getting at, which is exactly the question I want to move to next, is sort of what are the underlying fragilities? What are the underlying causes of that thing turning down? Because I think that's extremely important both for business and for policy. And so I want to get to that now. And so I want to think about the fundamental fragilities of the system. I've already talked about why there may be, why the financial system is so important. But I also want to think about, well, why is it that financial system seems to get into trouble a lot? What is it about the financial system? What's different about financial services firms than the non-financials? And that's what I want to talk about here with these three fundamental fragilities, because it's crucial to understand this, to prepare for and manage for shocks that can come up, whether it's in developed countries, whether emerging market countries, in any area. And so I think of these as kind of the three touchstones of instability. And so first is leverage. So financial institutions tend to have dramatically higher leverage than non-financials. And so for those of you who work in banks, and so what would be considered a reasonable amount of capital relative to your total amount of assets? Rajeev, what would today be considered a well-capitalized bank?
A well-capitalized bank or a safely capitalized?
Well, let's say by sort of like the international standards right now.
I would say, depending on the bank and its operations, anything close to 15%, 14%.
Yes.
Would be a safe level of capital from regulators, but in terms of practice, we'd probably keep a bit extra.
Yeah, you'd always want to have a little bit of a cushion extra. So that's right. So typically, the baseline today is that a well-capitalized financial institution has about 10 to 15% of capital relative to the assets outstanding. So for those of you who are in non-financial firms, what if you had that kind of leverage? What if you had that sort of leverage that's between 5 and 10 to 1? What kind of credit rating would you get? Before the financial crisis, there were many banks that were effectively operating with only 3 to 4% capital. So it didn't take much of a shock for people to be concerned that the institution was insolvent. The institution couldn't make good on its payments to all of its to all of the debt holders. All the people had obligations, and so we certainly have raised that today. So a capital asset ratio of 10%, dramatically higher than it was before. But is it completely safe and sound? For sure not. It's not completely safe and sound. But why do we let banks get away with something like this? Is because of what we were just talking about before. There's a potential benefit of banks being able to create more credit because they can provide more credit to the private sector for investment, for economic growth. What is the magic number? What is the right amount of capital? We don't know that. I wish I could, in the class I could just say, okay, it's 14.2, and once we get to 14.2, then we don't have to worry about a financial crisis. It's much more of an art rather than a science. Those standard errors that we were looking at before can be pretty wide in this, and so you can have completely reasonable people disagree. You know, so you can have the Elizabeth Warrens and the Jamie Dimons look at the same data and have a very different view of what appropriate capitalization would be, because we're not precise enough. I wish we were precise enough, but we're not. But the reason that we allow banks to run at lower levels of capital than non-financial services firms is because of the potential benefit for economic growth. Second is liquidity. And so you can either think of this as a positive thing that financial institutions do and you call it a transformation, or you can think of it as a negative thing that they do and you call it a mismatch. Because when you give your money into the bank, you can pull that money out pretty much at any time. So it's a very short-term kind of thing. It's something that's very liquid and that's very valuable to the depositors. You put your money in, you get some sort of rate of return, but you have this liquidity that you can pull out. But that's also, and that's a positive because that gathers more resources in for the banks to be able to lend out, and so lowers the cost of capital for people who want home mortgages, for people who are for home mortgages, for firms, for entrepreneurs, and so there's positives there. But you can see immediately that's a mismatch, because when the banks are making these loans over time, if people want to pull their money out, these people, the borrowers can't repay all of that immediately. The whole reason they're borrowing over a long time horizon is because they want to build a plant, they want to build a project. It's going to take time to be able to do that. And so those long-term illiquid assets, such as the loans and mortgages, are financed by the short-term illiquid or highly liquid liabilities, such as deposits and short-term borrowing, like so-called commercial paper, which is a debt instrument that's just very short-term. And so it's like a bond, but a short-term bond. And so the positive is they're doing this transformation. So individuals get a higher rate of return than they otherwise would. They get a liquid asset. Firms get lower cost of funding than they otherwise would. Households get lower cost of funding than they otherwise would. But there's an immediate fragility that comes in there. And Warren Buffett has a really great way of focusing on this. Cash, so that liquidity, is to a business as oxygen is to an individual. Never thought about it when it was present. The only thing in mind when it's absent. Because suddenly during the financial crisis, this liquidity disappeared. The ease of borrowing, the ease of getting cash, that disappeared, and no one had thought about that. Because just like with oxygen, rooms filled, we don't think about that. But if the oxygen were to be disappearing from the room, it's the only thing you can think about it, because your lifeline would be disappearing. And so that was just a really nice way of underscoring it. And finally, the interconnections. And so what's happened over time is that the financial systems become increasingly complex, increasing layers of financial intermediation, and so a lot more interconnections. In the old days, it used to be that you had a bank, and the bank would make a loan locally to someone who lived nearby, let's say for a home mortgage. And the bank manager might drive by the household and might drive by the house. They'd be able to see it. They'd have a very close relationship between the bank and the household. That's no longer the case. The banks will originate the loans and then they sell those loans off. Now there can be benefits to that, because if the bank keeps all of those loans on its books, it's exposed to a lot of local risk. And so you're putting all of your eggs in one basket. So by globalizing the household finance system, there are a lot of benefits to that. The banks are better diversified. The households get cheaper sources of financing because people can come in and invest in mortgage-backed securities rather than, and so get more funds in, because these loans can be sold off from the bank, put together in packages and sold off. But the challenge now is that with all these interconnections, you can't just look at one institution and decide, this institution's healthy or this institution's not healthy, because it's got so many exposures to other institutions and other markets that what you need to know is the health of the counterparty, et cetera, through the entire line. Because the institutions are all interconnected. They're interconnected through direct risk exposure, through particular contracts they have, and indirectly through different financial markets. And this is something that's true whether it's in supply chains globally. If there's a terrible weather event or a tsunami or an earthquake somewhere in Japan, that can have a big impact around the globe. It's true with epidemics, cybersecurity, terror. And that there can be these, you need to know all the different pieces in the chain, and it can create unexpected correlations, and so-called innocent bystanders can get hurt. I'd mentioned the case of Northern Rock, a small lender in the UK, in northern UK, no exposure to the US, no subprime in the US nor in the UK, the first one to get hit. And you could call them an innocent bystander. When we go through the case in class, you see that they were not very innocent. They may have been a bystander, but they were not very innocent. They were taking a lot of risks. They had very low leverage. They had very big liquidity mismatched, and they were relying on these international markets to finance them. So the interconnections were there. But if you just look narrowly, they were sort of an innocent bystander. But you can't argue that when you go to your board, or you go to your spouse if you have large losses, or you go to your investors and say, well, we did everything right, somebody else made a mistake, and they hurt us. That means you haven't done your risk management right. You have to be thinking about the context in which you're operating. And so even if you don't have the direct exposure, even if you are not taking a risky investment, even if you are not highly levered, if the other people you're dealing with or your others around are, you need to take that into account in your own risk management. So it's not good enough to say, well, we did it right, the others did it wrong. You didn't do it right if you didn't take into account the others are not doing things exactly right. And so I'm not going to go through all the specifics of some of these fragile interconnections, but for example, I'd mentioned securitization, that the banks could take the mortgage loans locally, put them into packages, and then sell them globally, which made for much better risk management for the individual banks. But what it did, as I say there on the bottom, it created a common risk factor, something that we didn't understand. And this was something where we had done a study, as well as the IMF had done a study of housing prices in the United States. So if you look back in the early 2000s, housing prices were going up relatively rapidly in the US. But they were going up even more rapidly in about 8 or 9 other countries around the world, major countries around the world. And so what we concluded from this was that, well, the US isn't an outlier. So the US is actually okay, we're not taking on excessive risk. That was the wrong analysis. We misinterpreted the data because with the change in the markets and having the securitization, there's now a common risk factor. So a problem in one housing market could be a problem in others. Frothiness in one housing market might mean frothiness in a lot of housing markets because they were using the same types of instruments, the same funders were there providing that funding, and so a problem anywhere in the system could bring down the houses everywhere in the system. We didn't understand the extent of those interconnections, and that was where I think a lot of people miss things, both at the Fed as well as other central banks around the world, because there was a common risk factor. We took inappropriate comfort in saying the US was not an outlier. Instead of what we should have done is said, oh my goodness, there are 9 countries that have even higher house price growth than we have. There could be a problem with housing throughout the globe. And so it was interpreting that data in the right way. You needed to have the right framework. You needed to have this framework of understanding these sort of interconnections and the fragilities, which we didn't have full understanding of at that time and are now much better. So I've talked about this shadow banking system. To just illustrate this point, and just briefly, you can see here, these are, for the mortgage-backed securities, they had different credit ratings associated with them. And basically the specifics of this credit default swap doesn't really matter. It was just a way of buying insurance against losses in the housing market. And so you can see that early 2007, everything's basically at 100, which means that no losses are being expected. And then things start to turn down. Actually, the first turn down for the lower rated pieces is in March of 2007. Now, remember, correlation is not causation. That's when I became chairman of the Supervision and Regulation Committee at the Fed. So it's correlation, not causation, clearly there. But you can see how a lot of people said, well, it's Randy's fault. He was there when this happened. But the higher rated pieces stayed up fairly high until the summer of 2007, when people said, oh my goodness, there may be larger losses here than we had expected in US subprime. And so what that means is, I'm not going to provide the financing anymore. I want to pull my money out. So I'm going to take my deposits out, or that short-term funding, because a lot of these long-term mortgages that were 30-year mortgages in the US were being financed with this short-term commercial paper that was 30 days or 90 days. And so what would happen is the banks would have to issue that again and again every 30, 60, or 90 days. And that was fine when everything was looking good. When it was like oxygen, you don't think about it, but suddenly the oxygen was taken out, they couldn't get the refinancing, and then the system came apart. And you see that here. So that darker line is the form of short-term financing that has asset backing. That's why it's AB, ABCP, asset-backed commercial paper. You can see dramatic, rapid growth, because this is the time of the booming housing markets around the world. And then people start to become worried in the summer of 2007, because some data are coming out that, well, maybe there are going to be larger losses than we expected in this market. And basically 3 years worth of growth of that market disappears within a quarter. And so that's exactly what Warren Buffett was talking about. That's the oxygen being pulled out. And suddenly it's like, oh my goodness, this business model doesn't work. And this is exactly what happened to Northern Rock. They had to do a major refinancing in the summer of 2007. They just happened to be at the wrong place at the wrong time. And so they were the first ones to get hit, even though they had no direct exposure to the US, no direct exposure to subprime. But they were using the same instruments that others were using, the same business models that others were using. And so there was that interconnectedness that came in that they didn't understand, that initially their funders didn't understand, and the regulators didn't understand. And so this is a nice way of trying to illustrate what happened in the crisis. There's some sort of initial loss somewhere in the system, so concerns that there are some losses with respect to some mortgages in the US, and so that causes these institutions to have difficulty funding themselves because people don't want to give them the money anymore, so they reduce their positions. And then this is now a very controversial statement here: prices move away from fundamental values. So how you characterize this depends on whether you're an acolyte of Gene Fama, one Nobel Prize winner, or Dick Thaler, another Nobel Prize winner at Chicago. So Dick Thaler would say, well, of course prices often move away from fundamentals. People get scared. There can be all these market inefficiencies that are there. And Gene Fama says, that's nonsense. I'm all about market efficiency. The markets work quite well. What happened during the crisis, because he acknowledges that a lot of the prices went down of these assets, was that there was a very high demand for liquidity during this time. So people wanted very liquid assets. These illiquid assets, like those mortgages, went down in value because there was a high liquidity premium that came in. So whether it's they're moving away from fundamental values or not, in practice, the values plummeted. We saw that in that graph, where even those highly rated pieces of the mortgage-backed securities fell down very, very dramatically. And then what happens? People are experiencing losses, and then you can't borrow as much against it. They might have been willing to say, oh, well, if you give us $101 worth of mortgage-backed securities, we'll lend you $100 on that. People were saying, my goodness, I think there are going to be very large losses, so I need 120 or 130. And even with 130, I might not even lend to you. So the leverage comes down in the system, there are funding problems, reduced positions, and you get this kind of downward spiral, and that's basically what happened globally. And also what's very interesting about this is exactly in parallel to what happened to emerging markets in the late 1990s with the Asia crises as well as with the Russia crisis. What happened is that there was a concern about losses in the system, and so that there might be some losses. And so there was what was called a sudden stop of financing, whether it was to Thailand or whether it was to Russia, and they couldn't repay their debts. And then you got this same sort of spiral that came down. Well, we saw exactly the same thing when it came to these banking and financial institutions. They couldn't get the financing. There was a sudden stop of the financing that was being provided to them. This is a classic illustration of a sudden stop. 3 years worth of growth just suddenly stops. Now this was to mortgage-backed securities, but if you had a similar kind of graph for Thailand or for Indonesia or for Russia, you would have seen exactly the same thing. The sudden stop of funding to those countries, that comes down, and then you get this downward spiral. So that's, again, we're thinking about the fundamental frameworks is very valuable, and so that's why, you know, when Bernanke, myself, and others who had studied the 1930s and had studied other countries were at the Fed, we had something that we could use as a way of thinking about what was happening. And that was something that I think helped to keep us relatively calm and allowed us to respond and think about, well, what are the key things we need to respond to? We need to respond to the leverage issue, we need to respond to the liquidity issue, we need to respond to the interconnectedness issue. And so I'll conclude just briefly discussing this. And so what this graph is from 2007 to 2009. And basically it's a measure of a risk spread that tells you, we don't have to go through the specifics of a LIBOR OIS spread, but the details don't matter. It's basically, in the financial markets, they think the bank is going to be around in 3 months or not. And so you can see before the crisis really heated up, there's a little blip that comes in when I take over the Supervision and Regulation Committee, but it came back down a little bit right at the beginning. You can see this distinction is less than 0.1%. It's like 8 or 9 basis points. But once the financial crisis, once the summer of 2007 hits, people become concerned that the banks would actually be able to pay off. They have such a low capital cushion that as they start to take some losses in mortgage-backed securities or mortgages on their portfolio, they're going to get hit. They may not be able to survive, and that's how that goes up. And then you can see on there, March of 2008 is Bear Stearns. That's when the Fed exercised its emergency powers that were given to it in the 1930s to respond to financial crises. And as with many things in life, the first time is often the most memorable. And I remember that quite well because even though I was chairing the Supervision and Regulation Committee, I knew what we were going to be doing, and we were working with JP Morgan Chase to take over Bear Stearns. They had a close relationship with them. They understood Bear Stearns well. We had to give them some capital relief in the short run. But I remember my heart really pounding when on that Sunday afternoon, the secretary of the board was reading off the propositions, which I knew exactly what we had negotiated. But one, I couldn't believe that we were faced with this issue, because this had happened since the 1930s. I'd studied about the 30s, but I didn't think I was going to be living something like that. And two, I didn't think I was going to be voting for something like this, because I'm a University of Chicago professor. And if you'd read all of my writings for decades before that, you would have seen that this is not a person who's going to support bailouts. And that's true, I didn't want to support bailouts. But it's what is the alternative? So actually, with the emergency powers we were exercising, it required a supermajority of the board in order to use these powers. The challenge was that the board only had 5 people on it, and the board still, it should have 7 people and had 5 people. It still only is shorthanded today. And the way the Congress set up the law, they didn't say supermajority, they said 5 votes or more, because they wanted 5 of the 7 to vote for it. There were only 5 of us there, so each of us had veto power. Any of us could have said no to any of these programs. But the question was, was I going to say no? So if we didn't provide some sort of support to avoid the collapse of Bear Stearns, would this have been a calamity for the system? Well, they were very interconnected through these various markets, and so it would have been a lot of knock-on consequences for other institutions. Would it have brought down the system? We didn't know. very hard to know about that. But we had a framework for thinking about it, a framework for answering questions, and we were sufficiently worried we thought, do we or do we not take the chance? Now, I'm on leave for University of Chicago. I know I'm going back to Booth, and so I certainly could have just said, well, no, let's see what happens. And if it doesn't work out, well, I go back to the university and there's a lot of variation in the data and I get to write articles about it. Well, that's not very responsible when you're in a public policy position. It's like, we just didn't feel like, and I didn't feel like taking the chance, and so we supported the transaction for Bear Stearns. And as you can see, there's a little bit of decline, but only a small amount of decline in that risk spread. So we prevented it from exploding at that point, but there's still a lot of tension in those markets. And you can see as we go further, as we're getting to September of 2008, a number of other actions that occur. There are some other large losses. And so we have then Lehman Brothers. And usually the question comes up at this point, well, you did something for Bear Stearns and you didn't do anything for Lehman Brothers. Why didn't you do something? You had the power to do it for Bear Stearns. You exercised that, and you just gave me this long song and dance about how you wouldn't have been supporting bailouts, but you did. And so my response usually is, time's up. Now it's time for cocktails. But what it was is we tried because that week was a truly amazing week for us and for the whole financial system, because Merrill Lynch was also in a lot of trouble. We were looking for a merger partner like we had done for Bear Stearns with JP Morgan Chase. Bank of America was very interested in taking over one of these companies because they wanted to get back into investment banking. They had been out of that for quite some time. And so they wanted to get back in. They looked at both, and they decided that actually Merrill Lynch was a better bet for them because they were very much a retail organization, and Merrill was much more retail. So they wanted to do cross-selling for that. So they bought Merrill Lynch. We still were looking for a merger partner for Lehman Brothers, and Barclays Bank UK bank was very interested in buying that. But as that week is going on, we're trying to work these things out. We suddenly find out about American International Group, AIG, a large insurance company. And we find out towards the end of the week that they say, some of the other regulators who were monitoring it, because we were not monitoring AIG, said, you think you've got your problems with Merrill Lynch and with Lehman Brothers? You ain't seen nothing yet. Because it turned out that AIG was the counterparty to nearly everyone. They had been effectively selling insurance in this so-called over-the-counter derivatives market, this credit default swaps market. That's just a fancy way of saying they were selling insurance against losses. And so they were taking a one-way bet. They were selling insurance to everyone. And because this was not an essentially cleared exchange, these were just bilateral transactions, the regulators didn't know it, the other market participants didn't know it. But then suddenly when everything was going down and they were going to have to make payouts at the same time to everyone, they didn't have the wherewithal to do that. And that's where you need to know the counterparties' health, because if you're exposed to AIG, as everybody was, if AIG went down, everybody else was going to go down. And so we were focused on that, but we thought we had the merger partner in Barclays. What happened is that, and I remember being on a call with Hank Paulson, who's Secretary of Treasury, and who, as Rajeev mentioned, I'm on his advisory board. He actually has an institute at University of Chicago called the Paulson Institute, and so we're good friends. And I remember being on a call and raising this issue that, well, the UK regulators don't seem to be as embracing of this transaction as they were earlier in the week. They seem to be a little bit hesitant about it, because we really needed to do over the weekend, the UK to do what we had done for Bear Stearns a few months earlier, to okay a transaction and make some exceptions for Barclays to be able to take over Lehman Brothers. And what happened was, so we thought they were going to do it, and I remember Hank saying, yes, Alistair Darling's becoming a little bit twitchy on these things, but I think we'll be able to get this through. And the next day we find out that the UK is not going to support the transaction. There was no no one else who could infuse capital into Lehman Brothers to take care of that, the losses feared losses that were on their portfolio. And so that's why Lehman Brothers went down. So we tried to deal with it, but we didn't have the instruments to do it because the central bank can provide liquidity. We can address that liquidity problem. We can do short-term lending against sound assets to solvent institutions. But we were concerned that the Lehman Brothers was insolvent and it needed capital, and we couldn't put the capital in. And that's where you then subsequently get the so-called TARP program, the Troubled Asset Repurchase program that was then subsequently passed, giving the Treasury Department the ability to purchase troubled assets, but it also had the ability to infuse capital into the financial institutions, and that was absolutely crucial. And so you can see it's the EESA, that's the Emergency Economic Stabilization Act, which is the TARP program that's passed. Interestingly, the risk spreads continued to go up during that period, because it wasn't just that it was passed. What are you going to do with it? Are you going to do the right thing with it? Are you going to deal with the liquidity, the capital, and the interconnection issues? And actually, the first program was with the Deposit Insurance Agency, the FDIC, this temporary liquidity guarantee program that doesn't get very much attention, but was crucial because we had deposit insurance, which prevented runs in the US from depositors. But effectively, what was happening is when people wouldn't buy that short-term commercial paper, that 30-day, 60-day, 90-day paper, that was like a run also. It just took 30 days or 60 days or 90 days for it to happen because people were not putting their money back in. They were not rolling it over. What this did is effectively extended deposit insurance to those short-term securities. So focusing very much on that liquidity issue. And then this TARP CCP, that's where we got the CEOs, the top 10 banks together and said, have we got a deal for you? We're going to give you some capital. Now, of course, some of the banks said, we don't need that capital. They're the ones who are in trouble. They can take it. We don't need it. We don't want government investing in us. And we said, well, okay, that sounds good, but do you really think that you're going to survive if 2 or 3 of the top 10 banks in the US fail? That's not going to have any contagion effect. That's not going to have any impact on you. Maybe it will. So I convinced some of them, not all of them. And then finally they said, we're the Fed. You're going to take this. And basically they took it. And then you can see the risk spreads come down. And so this is also not only a very nice illustration of the development of the crisis, it's a very nice illustration of my blood pressure during this time period, because this was all coming down on our shoulders. And as you can see, eventually things did come down as we addressed the liquidity and the capital issues. The interconnection issues were temporarily dealt with by putting that backstop behind AIG, and then trying to do some fundamental reforms of the regulatory reforms of the system to try to avoid those kinds of risk concentrations, both to give regulators a better idea of what's happening and to get things more onto centrally cleared platforms so market participants also could see what's happening. And so this gives you a little bit of flavor of the money banking and financial crisis course that I teach, a little bit of feeling for some of the lessons from a decade ago, and so I thank you very much for being willing to sit through a lecture in the evening about some things that weren't so good in the past, but hopefully we will learn lessons of how to improve things for the future. And if you take my money and banking class and other classes at University of Chicago, you'll find at least some proposed solutions for making us more stable going forward. Thank you very much. So I've taken a lot of your time, and so I don't know if we want to take a few questions or if we want to just leave it to the discussion. So you should feel free to go, because I've kept you. We started a little late, and I've kept you long, so I don't want to hold you. But maybe we'll take just a few questions if you have some, or we can just do it from the audience. Here, this gentleman here has a question. Oh, we've got a whole bunch of questions. Okay. Let me take a few questions together. So, gentleman here had a question, then Rajeev had a question, and a couple of questions back there.
Talking about fragilities, how do you account for risks which come from, which emerge from central bank policy decisions? 2008 clearly was an asset bubble, but then if you look at recessions from the past, one key factor has been central bank policy, where they have either hikes the rates faster than they should, or the other way around.
Okay, good. One question, then Rajeev. Good question. Then we'll take these questions here, and then I'll try to quickly answer them. And yes.
My question to you, Randy, considering this has been a US-centric crisis and a US-centric response, and we're dealing with a reserve currency that comes with a lot more responsibility, and obviously the stimulus led to inflating US debt, but also exported inflation to the rest of the world, and has led to a considerable amount of asset creation, much more than can be possibly supported in these economies. And then obviously when we went through a process of tightening and strengthening of the US dollar, the reverse effect of what we see in the emerging market remains. So coming back to the three elements of fragility that you mentioned, liquidity, leverage, and interconnectedness, and I'll link concentration to that. But the question I have is, in my experience as a banker, I've seen three more factors which I since add with some trepidation, and you're free to kill me for it because I don't have your credentials. But I think the integrity of management, the governance of boards, and the incompetence of boards sometimes who try to force decisions on managements to take action. And I think lastly, the culpability of assurance partners and rating agencies, because when you show us the top chart on asset-backed securities showing triple B to AAA kind of debt instruments, how much of that was really AAA and how much of it wasn't?
Sure.
Thank you.
Great. And then I think there were three more questions that will, so these three gentlemen have their hands up. Oh,
sorry, yeah.
I don't know if
I had a question based on what Rajeev was saying, that you talked about the economic aspects of how this whole crisis, the liquidity, the leverage is led to this whole thing. But what is the contribution of the excesses of the banks and the greed factor that led to this whole thing in terms of whether it's derivatives and all of the credit default swaps of AIG you talked about, running into hundreds of billions of dollars, $1 trillion. Couldn't the regulators detect this? And when banks, going back to 2007, comment by Citigroup CEO that the music is on and dancing, the music stopped. So it was a known fact that people were carrying huge amounts of risk, and it was publicly talked about in the Financial Times or in the financial media. So it was generally a well-known factor. So there's a greed nexus on it. How much is that a contributing factor apart from the fundamentals you talked about?
Hi, I have to ask a question because this is a unique opportunity to ask this. How much of an effect did it have on Fed letting Lehman go, the fact that Lehman did not support Fed's bailout plan of long-term capital management a decade earlier? I know it's just a coincidence, but it's something that I heard of my professor, who is also a Nobel Prize winner, so I put a little bit more credit to it. And it's a myth, but still a unique opportunity to ask that.
And one question in the back, and then I'll go and we'll take one more in the front, and then that'll really be it.
You had the crisis in 1929, and basically one of the results of that was the Glass-Steagall Act. We separate commercial banking from investment banking. I think it was Bill Clinton who reversed that, which led, in my view, to this crisis. Following that, Obama introduced Frank Dodd Act, which is basically the same, bit different, but fundamentally the same. And if I understand well, it's currently being removed, or it was recently removed by Congress in the US. So we're again in a situation where we don't have regulation that separates commercial lending from risky stuff. So in doing so, aren't we creating or removing the legal framework that is preventing this from happening again?
Okay, and one quick final question up here.
I won't wait for the mic, it's just easier. My
created. So do you see anything different going forward, or do you have different?
Okay, great. So I don't want to keep you here another 60 minutes for the next lecture, because these are all excellent questions. So I'll just touch on them, and then we can discuss them further over the reception afterwards. Lehman Brothers. So that's interesting. I've actually never heard that before, and so there are a lot of conspiracy theories about why Lehman was shot and we didn't shoot everyone else. That for some reason, like Hank Paulson hated Dick Fold, and there had been always a rivalry between Lehman Brothers and Goldman Sachs, and finally the former head of Goldman was able to take out Lehman Brothers. I mean, I never saw any evidence of this kind of thing, and no discussion about Lehman. As I said, this is the first that I'd ever heard of that. So certainly, maybe someone else was thinking that. So I can't be in the minds of other people, but I don't see any. I certainly didn't see any evidence of that or those kind of conspiracy theories. We tried, because if the UK government had gone along with and supported the transaction, then you would have had a capital infusion like before. I think part of what it was is our bandwidth was stretched. So we were dealing with all of these issues, and then AIG came up, and we realized how big AIG was, and we were at arm's length from the UK regulators, so we weren't as engaged with them as we should have been. And so I think that was to our detriment, that we didn't understand the challenges that the UK government was going to have earlier, rather than find out on that Saturday and then there's no possibility of infusing capital. The first two questions kind of had more to do with central banking and central bank credit creation, and sort of things that have gone on since the crisis, and certainly there's been a lot of concern at first that there would be high inflation of the central bank actions. Obviously, that has not happened. We've not had high inflation in the U.S. or in other countries that had responded, because there's a very high demand for short-term liquid assets for those reserves, and so that didn't lead to high inflation. In different circumstances, it could have, but we didn't think it would, and it didn't in this circumstance. The issues of the broader issues, getting to kind of the second part of the second and third question on greed, governance, and all that. I do think that there were very important governance failures that occurred, and some of them may have been at credit rating agencies, but also some of them were with investors. Because a lot of investors did not do the due diligence that they could have done on their own. Now, there are some investors who had to rely on third-party credit rating agencies, but there were many large investors who didn't have to rely on those agencies. They could have done their own due diligence, and they chose not to, because they were getting a little bit higher rate of return for something that was AA or AAA, and they were happy not to ask questions about that. So the incentives are not. There were incentive problems that went in a number of different areas. Some incentive contracts that people would get payoffs in the short run, even though some of the risks would have been realized in the shorter run. We've tried to address some of those, getting a little bit at this question. So now compensation schemes are a little bit different than they were. There's a longer vesting period. The ability to claw back gains that are seen as problematic subsequently. This issue is now coming up with Goldman Sachs. This issue came up in force with Wells Fargo, where they had done where the management was seen as done a number of things that were inappropriate, and so tens of millions of dollars of bonuses of promised bonuses were taken back from the senior executives, and tens of millions of dollars was enough even for senior executives of banks to notice. So there's some on that. So there were incentive problems that were there, but the incentive problems were much broader. They were also on the purchaser side and on the investor side, not just on the credit rating agency side. So there were definitely a lot of governance issues there. Some of those governance issues have been partially addressed, but I don't think they've been fully addressed. The response to the crisis in the 1920s was to separate commercial banking from investment banking, and then in the Dodd-Frank Act, some of that some of a step towards that, the so-called Volcker Rule, which didn't allow banks to engage in proprietary trading, was part of Dodd-Frank. That is getting another look at it, because actually the way the legislation worked and the way it was implemented has just not been effective. And so the legislation is still there, and so it's still on the books. The way it's going to be enforced by the regulators, it's out for comment. They are in the process of reforming it. It hasn't been working as it is. The problem with it is it's focusing very much, the way it's been implemented, it focuses on these narrow metrics rather than the big picture, what kind of risks are you taking? And it should be focused on that big picture issue, and I think it hadn't been. So I don't think it was being effective before. Hopefully in the reforms it will get the supervisors to focus on the big issue, what risks are you taking, rather than a 20 list of boxes that can be checked, which are not really things that are getting at risk, but are getting at particular metrics that were used because the legislation wasn't so clear. And so, as I said, we've done some things to improve. I think on the leverage front, banks are much better capitalized than they were. That doesn't mean that there's not going to be a crisis, but instead of having 3 to 4% capital, they're 10 to 15% capital. Liquidity issues, we're much more aware of those liquidity issues. There's much more monitoring of liquidity and requirements for much more liquidity. And that's actually part of the balance sheet expansion that the central banks has provided a lot more reserves to banks in the system. And even as the Fed runs down its balance sheet, it undoubtedly will still leave a lot of that cushion in the system. So there'll be a little bit more liquidity cushion. On the interconnections, that's much more patchy. We've done some things to try to reduce some of those risk exposures, but it's not complete, and there's always going to be some interconnection that we haven't seen. No one is going to be able to see all of the pieces. The Office of Financial Research, the institution that I chair the advisory committee to, is trying to do that, but it's an impossible task to just say, we see every risk and we can identify every possible risk coming, but at least there's now an office that's trying to gather data to look at those things. So we'll be better prepared, but we won't be perfectly prepared for that. So I think we have made progress. And I thank you very much for staying for such a long time, for bringing me through my crisis period with my blood pressure, and hopefully going forward, my blood pressure and your blood pressure doesn't have to go up. But as I said, there's still a lot to be done, and that's going to be one of the fun things if you come to one of the University of Chicago Booth School of Business programs, either the Executive MBA program or our Exec Ed programs. We can talk about where those risks still lie. Thank you very much.